Well, hello, folks, and welcome to this session. Today we're going to be talking about stablecoins versus tokenized deposits and CBDCs. But first, let's set the stage. Tokenization is reshaping how money itself exists, and currencies, that ubiquitous means of value distribution in today's world, has become a hotbed of innovation in something which can be quite boring. So from stablecoins to TDs to CBDCs, today we're going to unpack the sticking points and some of the solutions that need to be addressed. And ultimately, our panelists are going to determine where they think value will reside. By way of introduction, I'm Theo Golden. I'm a portfolio manager, and I lead on tokenization at Baillie Gifford. We're a UK asset manager and run about $300 billion of dollars under management. And to introduce our top-tier panelists, we've got Ryan Hayward, who's the head of digital assets and strategic investments at Barclays, one of the UK's biggest banks, and oversees the bank's digital asset strategy. We've got Xiaonan Zhao, who leads UBS's strategy and execution around digital assets, including initiatives in CBDCs, digital issuance and digital payments. And then we've got José Fernández de Ponte, where he's tasked with driving the ecosystem growth as president of the Stellar Foundation and scaling portfolio companies and expanding adoption. So really excited to dig in. So maybe just to start with a scene setter, I think if we're going to determine what's the best, we should probably determine what the problem is, right? So that's maybe where we'll start. So Ryan, what is the core problem you think digital forms of major currencies are trying to solve, and who's it for? Is it settlement speed? Is it programmability? Is it inclusion? Is it resilience? And do you think any of these one solution solves it all?
Well, nice to speak to you today. So I think they're all potentially solving for slightly different things, and so I guess it depends a bit on form versus factor. So CBDCs, I think, are often touted for this financial inclusion point. I think that is maybe slightly tenuous depending on the jurisdiction, but I absolutely get where they're significantly underbanked sections of the population in certain jurisdictions or countries where you may see that come into its own. I think for something like transferability or cross-border payments, CBDCs are a harder axe to grind, because I think you've ultimately got to get that coordination across a number of central banks, and that is easier said than done to get out of the gate. Something like programmability, I think, probably applies to all of them, and really that's just the foundational basis of trying to upgrade your capabilities of money. And as soon as you start to accept the fact that more finance and assets are going to go onto chain, and you're going to want the ability to have a series of transactions or have DVP or PVP moving together, I think that programmability is sort of pretty fundamental to all aspects of it. But I do think something like tokenized deposits occupy quite an interesting part in the ecosystem. They're maybe slightly newer as banks are starting to think about this capability and how they roll that out to clients. It definitely gives you the programmability piece. It potentially gives you that speed of settlement, given you've got the existing two-tier structure and TradFi is already connected up to most of the things you're going to need. The interoperability or cross-border piece is harder to solve, and I think people recognize that. But we've been working with a few of the banks around something called GBTD, which was the RLN project, and again, at least that's trying to solve some of that interoperability, at least within borders. And then we know there are other cross-border on-chain cash solutions which you can link up and start to provide some of the capability. So again, I think different for different form factors, and therefore ultimately you see a plethora of solutions that will coexist.
That's pretty helpful. I'm going to be slightly cheeky and bring Jose in. The easiest reaction to that is, well, Ryan, you're a banker. So you'd want to say something along those lines. And Jose, I'd maybe invite you to challenge and maybe give us a bit of a more of a DeFi angle, or maybe just, are stables solving something which the other two can't?
I think they are, and hopefully the next time that we do a panel like this, we're going to call it stablecoins and tokenized deposits and CBDC, because they serve for different things. If you think about the types of money that are out there are essentially three types of money. There is central bank money, commercial bank money, and then e-money. And stablecoins are basically tokenized e-money, when tokenized deposits are tokenized commercial bank money, and CBDCs are tokenized central bank money. If you think of the stuff that you can do with stable coins, that people should think of stable coins as the money that you have in your fintech wallet, in your PayPal wallet, or Venmo, or Revolut, pick the one you want. But now all of a sudden you can use it everywhere. And those are things that are different than what you can do with tokenized deposits. Tokenized deposits are a fantastic instrument for interbank settlement. I struggle to see them as a payment instrument for retail. So what happens if somebody pays me with a tokenized deposit from bank X and I want to liquidate that in country Y, how does that work? And if it is commercial bank money, it has counterparty risk for that commercial bank. So they serve different purposes. I think that absolutely there is a space for tokenized deposits and there is a space for stablecoin. The way that we think about the problem that we are trying to solve is access to financial services. Stellar has been around for about 10 years, and the mission has always been to increase access to everyday financial services. And in some cases, we're going to use stablecoins for that. There is a lot of work that has happened in remittances or disbursements for refugees, where stablecoins are the best tool for the job. And there are going to be some other instances in which we will want to use, or our ecosystem will want to use, tokenized deposits. And if there is a moment in which central banks are issuing real CBDCs and they choose to deploy them on permissionless blockchains, we would love for them to deploy on Stellar too.
And Xiaonan, that's probably a good point to bring you in as well. Obviously, you've done a huge amount on CBDCs. To a lot of folks who are in the TradFi world, it feels probably pretty familiar and we kind of can grasp it. But for people who are more kind of crypto native, it can sometimes feel that it's a solution in search of a problem. So I guess what's like the core value add? What's the core differentiator of a CBDC and how can it deliver on that promise of public trust?
Yeah, that's a really good question. I think when we're looking at CBDC, we have to distinguish the different types of CBDC. So you have the wholesale central bank digital currency, wholesale CBDC, which is actually the digital currency that we probably explored more deeply from the institution perspective. You also have the retail CBDC, retail central bank digital currency. For example, in the euro, digital euro is being given a lot of push by the politicians. So those type of retail CBDC probably more being used for the day-to-day use of yourself and myself, potentially buy a cup of coffee or pay the train ticket. So when it comes to the CBDC, I would not say it is a solution looking for problems. I would rather say it is a solution that is targeted for multiple different type of needs. So very concretely, for the central banks or for a nation, the central bank digital currency or even just the traditional central bank money that represents the sovereignty of a country. It is the tool, no matter in the current society or in the digital economy, to really control and also to monitor, to influence the financial stability, and to allow the securities of the society, and most importantly, to create a trust anchor. This trust anchor matters for the day-to-day use and also matters for the financial economy and large institutions. So maybe give you two very concrete examples where UBS is heavily involved in the CBDC initiatives. So I always just say, okay, when it comes to CBDC or central bank or digital currency, look at the capital market and also look at the transaction banking. So from the transaction banking world or the correspondent banking experiment, there's a very famous project now led by the Bank for International Settlement, the BIS, joint force with 7 central banks globally, including the Bank of England, Swiss National Bank, New York Fed, etc., etc. So UBS is one of the commercial banks joined this initiative together with another 40+ commercial entities. So through this initiative, what we are going to hopefully see is how the tokenized central bank reserve in the wholesale space and the tokenized deposits of a commercial bank can be interoperable on a unified ledger or unified platform. By doing so, we will have 24/7 faster and more efficient and cheaper cross-border payments. So this is something that we want to achieve, and we can only achieve by having the tokenized central bank reserve on-chain as well. Because in today's world, as much as we want, okay, you can cut off the correspondent bank from 7 or 17 to 2, but ultimately, when you have to do the settlement and clearing between two institutions, central banks have to come to play. A second example I can quickly give you is in the capital market space. So UBS is also involved in the Project Helvetia, which is the Swiss National Bank's initiative of using wholesale central bank digital currency, and it's a real wholesale central bank digital currency. It's not fake money or play money, right? It's a real money, and to use this wholesale CBDC in the Swiss franc to settle financial transactions, including bond issuance, etc. So why do I mention this? Because back in 2022, my team, together with the Treasury colleagues, we already launched the tokenized digital bonds in the Swiss market, 375 million. So back then, we did have a digital payment rail, but that was not a wholesale central bank digital currency. So we do have benefit from the efficiency, from the speed of a tokenized bond issuance and the settlement on digital rail. But what we could not achieve is to reduce the credit risk down to zero intraday at least. So here comes the play of a central bank digital currency by the Swiss National Bank. So last year, when we launched our another central bank, another digital bond, we were able to use the wholesale CBDC in Swiss franc to settle our digital bonds. So that achieves the ultimate risk reduction for the wholesale financial institutions. So just want to share these two examples.
No, those both very helpful examples, and I think it's kind of helpful also for us to ask the question, because obviously we're kind of starting these kind of quite old school financial institutions, particularly the three of us, and these can feel like kind of tangible examples in our kind of everyday work, but it's often actually quite hard to think about that in terms of just people on the street. What does the benefit of having much more interoperability between commercial bank digital money and central bank digital money? Why is that an improvement? Why is that better for Joe Bloggs on the street, rather than just kind of being a helpful liquidity feature and a gizmo for our kind of incumbent banking organizations?
So valid question. I guess the consumers always get a slightly warped, impression of how exactly that financial ecosystem's connected together. And they in the UK you benefit from faster payments, so everything looks pretty seamless and instantaneous. Obviously, that's not quite true in the back end, and that in itself brings costs, which ultimately have to be funded some way or another. I think. Even when you look at something like faster payments infrastructure, which is very helpful in terms of allowing that seemingly instantaneous switching of payments from account to account within the UK, that is still legacy infrastructure. There is a question of how do you upgrade that? What does that look like? How costly will that be? And so I think as you start to get on-chain or financing moving to on-chain solutions, there's naturally a jumping off point where you start to say, well, hold on, should we not think about what infrastructure we should be building in the 21st century? And I think the UK Treasury has already set that task with things like their national payments vision. That's a bit of a call to arms, both amongst the regulators, but also some of the commercial players like the banks, to start thinking through, logically, in some sort of sequential fashion as to what you need to do to build out or rebuild some of the UK payment infrastructure. And I would think digital assets naturally fit into that. But I think it goes back to the point, one of the points made around even at the retail level, if you want to go and transact with, let's say, securities, that experience is still quite clunky. So even though maybe you can do account-to-account payments quite quickly, when it comes to trading securities and you're trying to do DVP, that still takes time because that goes through CREST on the asset side. That has its own settlement cycle. So as you start to see the swathe of bringing assets on chain or tokenization, if you want, and that can marry up with digital cash, you start to see all of that reduce down. And then there are other use cases, like again within the context of GBTD. A couple of the use cases that we're looking at, which is effectively this interoperability of tokenized money between banks. Couple of them, one is a peer-to-peer use case. So the idea again being, well, you've got account-to-account transactions amongst your peers or amongst other account holders. You don't necessarily know them. So let's say it's second-hand marketplaces, your Gumtrees, your Facebook marketplaces. How do you solve for that potential for fraud or for transactions that ultimately you're having to wire money, but maybe you haven't received the goods? So there is potential capacity there to have locking capabilities, which you can associate with programmable money. So that is potentially helpful. And then when you think of things like the mortgage journey, which is another interesting example, trying to stitch up housing transactions, very complicated. If you've got, let's say, 7 parties in a chain, and you've got to go and fund into all of your conveyancers' accounts, and then they've got to go and sequence all of those payments into someone else's accounts. You can easily get into cutoff times because your traditional infrastructure is not 24/7, it doesn't move on weekends, etc. It'd be potentially a lot easier if all of that money stays in the accounts and you can potentially lock that and say, okay, everyone can validate that all of this is here, it's all locked so it can't be used for alternative purposes, but as soon as everyone's done, you hit click and everything goes. And ideally that happens on the asset side or the property title deed. So I do think you'll actually see, even though a lot of the benefits may sit ultimately on the wholesale side, I think retail customers will start to see those benefits and piggyback off some of those infrastructure upgrades.
Xiaonan, did you have anything to add to that, or?
Yeah, I think maybe just quickly commenting from the retail side. Of course, UBS, we do not operate retail banking outside Switzerland. But I think maybe just mentions things like in the Swiss retail ecosystem, right? We do have a very advanced platforms, things like Twins, etc., already allow you to do very fast payments between the retail users. However, I think in the different nations, we still start seeing, as you said, the instant payment being rolled out in different countries. So what does that mean? It means for the retail user, we do not necessarily need to pay up to benefit from these services. However, if you look behind the scene, it is the bank, like ourselves, actually have to pay or have to build the infrastructure and have to actually also to preserve the liquidity to making sure we can really fulfill the 24/7 redemption requirements when our retail user needs. So I think why do the retail people need to care? Because they need to care. This is all the costs that will eventually passing on, no matter to themselves directly or from the different channel to the broader population.
Yeah, maybe to add to that, one of the things that I found really, really interesting when we're having conversations like this about use cases is sometimes the premise is a bit, let me say, reductive. I think that all of us, we spend a ton of time in rooms where people are asking about the use case, and I'm sure it happens with the audience as well. They say, hey, why do we need stablecoins if we can have tokenized deposits? Why do we need X if we have Y? And I think that in some cases it's a fundamentally flawed question. So when you look at from the regulatory point of view, I think it's important to keep in mind that the role of the regulator is to maintain financial stability and consumer protection. It's not to demand ex-ante use cases because they're not there to gatekeep and vet the use case. The market will come up with a use case. And we've been in this game for long enough that it feels like we're starting to find out the granularity of the use cases. I used to run a fairly large remittance business inside of PayPal, and the reason that we started to move that towards stablecoin was not ideological, was not for decentralization, was because it was better FX, faster settlement time, less counterparty risk. But then 2 weeks ago, I was talking to someone who's a large asset manager who operates on the secondary market for non-performing loans. Their point of moving some of their flows into stablecoin was time to cash. They say, hey, it takes me 2 weeks to collect the money, and then I need to go to the service agent, and I need to see which liability goes to whom. Their time was 2 weeks to 2 weeks faster cash to after collection. So all that granularity of the use case will come from the subject matter experts in each specific business and the people who are interacting with it every day. And I think that we're starting to move from the very plain vanilla use cases that we used to talk. Say, hey, this is going to be good for cross-border payments and remittances. We have gone to the opposite extreme on, hey, this is very good for DeFi and for programmatic lending and borrowing. And now we're starting to find that space in the middle where people have accepted that this is here to stay, and this is a technology that is getting to the point where enterprise-grade solutions can be put in place. And it's going to be on all of us to find out what is the specific use case where it makes sense. And in some cases, maybe it will not make sense, but I believe that in many it will.
Maybe I can just comment on that, just to follow up what you have said, right? And also from the end user perspective, no matter they're retail people or they are corporate institution, I often find that they do not want to take the burden of doing the integration and getting used to the new system or too many new different platforms. So it's really the responsibility of ourselves to making sure this transition is as seamless as possible. Just take some examples. I speak with our corporate and institutional treasurers very often because the tokenized deposit, for example, we're working on right at the moment, is really at this first stage target for those audience, right? So from their perspective, especially corporate treasurer, they normally do not have a large treasury operations team like a bank, right? They have very limited capacity resource. So for them to actually plug into a blockchain ecosystem or rail is very difficult. Then they probably still using a little bit more, legacy treasury management system to doing their cash flow and the payment. So if we are now coming up with a new type of DLT payment, asking them to integrate, it's very difficult to sell the gig. So I think it's really about how do we actually help those treasuries and no matter institution or corporate to do the intraday liquidity management a lot better. And that, I think, also comes up with the new solutions like tokenized money market fund, and that is a completely different story. We probably don't have to comment it today.
I mean, that's an interesting one there, especially around. So one of the core use cases we see is around that treasury management function, and particularly for kind of multinational companies, which genuinely have just archaic systems, and it's a painful process. Do you feel that, particularly on the banking side, and I'll start with José as maybe the challenger, do you think the banks are moving fast enough to build those solutions in a way which the tangible benefits are visible? Or do you think that there's a slight kind of paradigm kind of taking place where the banks necessarily aren't moving quick enough to develop those solutions, and folks are looking to stablecoins because they want to, they see the end goal, they see the vision, and they just want to deliver it now and right now and here, rather than waiting for their banking counterparties to catch up?
So, of course, I will always want the banks to move faster. But also you need to remember that the banks are not there to move fast and break things, are there to move and make sure that nothing breaks. So there has been early adoption. You would expect the early adoption to happen in other places. The good thing of the banks is that when they start moving, it's very difficult. It's very difficult to get them to move, but it's also, once they get moving, it's very difficult to make them stop. And you've seen probably that the early adoption obviously was on crypto ecosystems. Then it was, you saw the payment companies. I'm seeing a ton of activity on the asset management side. And I'm seeing a ton of conversation on banks, especially around stablecoins, less about the RWA side. You want them to move faster, of course, but especially you want them to move decisively, because you don't want, I think that we are past the point of innovation theater and proofs of concept, and that's something that we had to go through, but we are on the other side of it. Massive distribution will happen in the places where the retail and corporate customers are today, and those are largely with the banks and the asset managers and the payments companies. And as Xiaonan was saying, you need to make it easy for your client to say yes. They will not have laser eyes. They're not going to care about decentralization for the sake of decentralization. So getting those distribution channels, you don't get to liquidity and distribution if it is not through the existing financial tapestry. So yeah, I would want them to move faster. I'm extremely happy that they are moving.
Well, I can certainly say that two people are moving very quickly. We got them on the stage. I just wanted to ask, maybe Ryan, I'll start with you. It feels like the conversation around stablecoins particularly has moved really quickly in a very short amount of time, despite a lot of us maybe talking for a while longer, but it's definitely come into the hotbed of discussion. I've certainly been asked by more clients about stablecoins than I have ever in the last 6 months. So, but one of the questions we get asked a lot is the standards that have been set. Are they the final set of standards that we'll end up with in 5 years' time? Do we think there is still a progress towards better and improving solutions, and what does that look like? And maybe I'll start with Ryan. As said, is there a second mover advantage for regulators like the UK to iterate and improve?
Yeah, I think that's fair. So I agree. The speed of change across stablecoins has been pretty fast, and we know why that's happened. It's been a transformational year. As you said, there hasn't necessarily been that guidance in place for a lot of jurisdictions. So that's just taking shape. Banks, at the very least, want to see where that lands, and as I said, the ink's not even dry yet. They've still got to be implemented, so there's still a process to go through for that. I think it's a relevant point you made about something like Miko going out first. Very helpful, useful to set some sort of standards. But obviously, if the ground shifts from around you, that can very quickly look like it's slightly out of kilter with maybe the direction of travel elsewhere. So no doubt there may be recalibration of that at some point. I think your point about how quickly that's starting to move, and it's an interesting dynamic, because you've definitely got these pockets of DeFi system which can move at great pace. I mean, still, I think where stablecoins are today versus where they will be in 5 years, both the regs that may shape that will be quite different, because I think regulators are, unsurprisingly, to a certain extent, cautious, and they want to understand the risk. They definitely want to avoid unintended consequences of, huge liquidity drains out of the traditional banking system or something like that, or obviously depegging risks and those kinds of points. So understandably, they're slightly reluctant to just fully embrace it. But by the same token, I think stablecoins are at the starting innings. So in terms of, what those things are used for, how they're moved around the globe, that's still very early stages, right? It hasn't even really permeated significantly out of the crypto space yet. The infrastructure, although there has been some of this built, the idea of, to the distribution point, the idea of getting stablecoins into the traditional financial ecosystem, that's still in the process of being built out. How do banks connect to this? How do they accept it? What is their role in the ecosystem? Are they going to manage reserves? Are they going to issue coins? This is all happening at once, and you've seen there are various banks looking at different solutions. They're obviously speaking to some of the existing private sector operators to try and work that out, and it's all ultimately happening real time. But I think your ultimate working hypothesis that things will look quite different in a few years' time is a fair one.
And I guess one thing I'm interested in, particularly in context of this weekend, which was sharp and painful for a lot of folks potentially at this conference, but something that I was thinking about it this morning was would CBDCs or tokenized deposits would they have been a help or a hindrance in this kind of weekend's market activity? And kind of by parcel of that, will we ever see something like a tokenized deposit which is truly interoperable with DeFi and truly actionable in the way that we want to use, maybe as a broader ecosystem within decentralized finance? Maybe I'll start with Xiaonan.
Yeah, I think so. A tokenized deposit, I think at this moment, I think is also at the early stage. Most of the large banks today is exploring what to do, and many of them now is coming to a stage to launch or already launched. But one big constraint of the tokenized deposit today is that everything is only working within their own ecosystem. So you can only send a tokenized deposit from one account to another account, one client to another client within the same banking ecosystem instead of cross-bank. So I think that is a challenge that all the large banks who are, like myself, working on the tokenized deposits, fully aware and wanting to address. So how do we actually address this issue? There's multiple ways to do so, and of course you can always go off-chain and on-chain, off-chain, on-chain to facilitate this if you have to send tokenized deposits to other parts of the world where your banking ecosystem is not stretched to. But then you can also using the other instrument. For example, if the likes of Project Agora went live, then you will have a multilateral scheme to allow the money to go across the globe. Yes, stablecoin and DeFi, there's also bringing new possibilities, right? Because many people now assessing, okay, would stablecoin be a good option for the last mile of a payment when the money needs to go into a country, especially if that country is underdeveloped. When it comes to DeFi, I think it's also an interesting point because today we certainly see more stablecoin and crypto being used in the DeFi world instead of tokenized deposits. But we also know like the DeFi players do use their traditional bank account to upload or to unramp their money into the DeFi system. So I think it's a matter of what is the best user experience for the DeFi players to feel they can actually get the money into the system.
But I guess the only other thing is obviously there is a little bit of a convergence that has to happen because while there hasn't been these rules and regs around stablecoins, I guess people kind of cotton on to the fact that you need some of that in order to bring that into the mainstream, and then it starts to become a little bit more on a par with the other forms of money. So I think that's something that will inevitably start to happen.
Agree.
And I don't know, I mean, Friday was just it's a very, very short time ago, right? So I think that probably we still need to know the details of what happened. But it was obviously a very sobering reminder of what can happen in terms of concentration and leverage when the markets do the thing. To your question, I don't know if CBDCs or tokenized deposits would have helped mitigate that in a first order. Probably they would have in a second order, in the sense that if you have more trusted collateral, you have more players in the market, you get more resilience built into the system, and the fact that there is excessive centralization on a small number of exchanges or oracles or market makers exacerbates some of these tensions in the market. So if you are able to provide some of those instruments that are more widely accepted and more folks get into the system, that provides a more resilient membrane that can absorb some of those shocks.
So I guess to summarize that kind of commentary, it sounds like you kind of all expect them to interact with each other, but stablecoins will still remain the dominant payment rails within DeFi, but ultimately tokenized deposits might provide a better second order kind of buffer to make the on and off ramp much more feasible and interact with the stablecoins. But stablecoins themselves will still be the dominant form of money.
I guess it goes a bit back to the point. It's still very early in the innings, right? I mean, you look, some people are starting to experiment with this notion of can you move deposits, tokenized deposits, onto public blockchain. You know, these are conversations which were not really prevalent last year. I guess they're starting to become more of a theme, but then you've got a lot of mechanics to work through as to how that fundamentally operates. But there's no reason why some of that can't be projected into more open ecosystems so long as it's got the controls around it. So I wouldn't necessarily say that assumption is totally guaranteed. That could be tested.
And some of these things are Lego bricks. I think that we tend to see them as compartmentalized, but I don't see any conceptual reason why you wouldn't see a stablecoin that has tokenized deposits or CBDCs as part of the reserve. So there are some, and I don't see a lot of CBDCs who are considering being deployed on permissionless chains. So some of these things will build on top of each other.
For sure. And one thing I would want to touch on just before we finish is just really, the issue of kind of fragmented liquidity. And so I think this is one of the core things, definitely when we talk to regulators, it's at the heart of the issue, and particularly prevalent in the UK when basically one of our only major industries left is banking. And the core business model of banks depends on basically front-end deposits. So how do we move forward in a way where we firstly aren't fragmenting liquidity in a way which is detrimental to end consumers? And secondly, how do we, and this is maybe more of a question for the banks, how are the banks thinking about doing that in a way where their business model still can survive in this ecosystem and you know, essentially the spread that they earn as a business model entails can be continued in this environment? Maybe I'll start with Ryan.
So, yeah, I mean, like everything, I guess it's always an opportunity and a challenge for institutions. But I think the idea, people have talked about it earlier in the day around collateral optimization, intraday liquidity. There are a number of firms who are looking to help solve that for institutions. And you look at the banking sector at large, it's no surprise to them that finding some of those growth levers are difficult. So optimizing is absolutely part of the name of the game, right? And reg requirements go up. Categorizations change, and so you've ultimately got to look at mechanisms for freeing that up. And so moving to a more instantaneous intraday type market is absolutely something that I think banks recognize can save them money, can save customers money. That doesn't necessarily need to come at the expense of traditional models, in the sense that there's no reason why you can't continue to leverage your distribution. If you're freeing up collateral for you and clients, and they're able to recycle that faster and use that more, then no reason why that can't translate into more trades, and you can still have your custody solution sitting behind that. So I think there's a lot to play for there, rather than just assuming it's all doom and gloom from the perspective of the banks. Yeah.
Yeah, so I think liquidity fragmentation is not a new thing. I mean, even in today's traditional world, right? I often say today's financial ecosystem is like a patchwork on top of a patchwork. There's so many different venues and liquidity places, and sometimes we have to place liquidity at different places just to making sure we can do the settlement, we can do the payment on time, fulfill the customer requirements, and without the delay or penalty. So I think in this new world of tokenized deposits, CBDC, and stablecoin, etc., we really need to making sure things are interoperable. But it's not just a technology interoperable. It should be a scheme, consortium, collaboration interoperable. I think from tokenized deposit perspective, we are unlikely to see different type of tokenized deposits, right? If it's a UBS, you have one type of tokenized deposits, Barclay, one Barclay tokenized deposit. But I think I worry more on the stablecoin side, because we already see different type of stablecoin issuers, and in the coming years, you're probably going to see more and more. So how do we making sure that we can still be interoperable in the stablecoin space? We will have different liquidity in the stablecoin spaces, and that the same applies to the crypto world as well.
José?
Yeah, absolutely agree with the point on liquidity. I think it's exceedingly important, and probably the way you solve for that is through interoperability. The death of the fractional reserve system is a particular pet peeve of mine, because I've been hearing that for 15 years. There is always something that is going to kill the fractional reserve system. 15 years ago, fintechs were going to kill the fractional reserve system, and 3 years ago, private credit was going to kill the fractional reserve system, and now stablecoins are going to kill the fractional reserve system. I don't think that's the case. If you look at it just purely from a scale point of view, there are probably 300 billion of stablecoins out there. If you look at the US side, which is the market where I have probably the best perspective, it's anyone's guess, but probably 50 billion of stablecoins are in the US at any point in time. That is not going to kill the fractional reserve system. And if the regulator is concerned about it, there are ways to address that. So there were comments from the Bank of England a while ago about potential limits on stablecoins, but more realistically, you could just enable bank deposits as part of the reserve, and then it flows through there. I don't think that anyone is thinking these days that the balance that consumers have on the Revolut wallet or the PayPal wallet or the Venmo wallet is going to kill the fractional reserve system. So there are ways to manage to make sure that that doesn't happen.
I can't remember if it's a Churchill quote, but the news of my death has been grossly over-exaggerated or something like that. Just in the final 10 seconds, you can't say all three. Tokenized deposit, stablecoin, CBDCs, your personal favorite. José?
I like them both, but the stablecoins and tokenized deposits are higher in my list.
Xiaonan?
I would say tokenized deposits, but everything will coexist in the future.
And Ryan?
I'll plump for tokenized deposits. I am a banker after all. So.
Brilliant. Well, thank you all very much, and thank you for your insights, and hope everyone got something from that. Thank you very much.
Thank you.